maybe it might be helpful just to say what I don't do,
Sure.
um, to maybe better understand kind of the approach
Sure.
that I take. So I mean, as a quant, I look at the strategy sort of holistically. All the data is in the data set, so every line item from 10Qs and 10Ks are in the data set. You can extract that. It's 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 all there. It's a database. So for me, I don't need to go into individual 10Ks or 10Qs.
Mm-hmm.
So I don't read them. I don't read footnotes. I don't read that stuff. Just for the approach that I take, I don't really need to. Some would argue, and perhaps you would argue as well, there's a lot of little good nuggets in there that can maybe paint a different picture than what the numbers are saying. And I'm sure that's the case in many cases. But for me, in my approach, it's 100% quant. So
Right.
if it's not in the balance sheet, the income statement, cash flow statement, then I or the technicals, then I don't take it into account.
Are you looking at things like customer concentration? Is that a stat you would look at, for example, or you wouldn't even look at that?
No, I
Right.
don't have a factor for that. Um, but I've got, maybe you could say, proxies for similar things, like for example, market share is something like that's not immediately from a 10K, but you can aggregate or look at industry wide
Okay.
trends, and
Mm-hmm.
then kind of piece together the actual market share of a given stock. You can try and forecast TAM,
Mm-hmm.
kind of things like that. I've kind of toyed with those things with some success, and then some where in other areas doesn't work so well. So it's I guess what I'm trying to say, it's something that works for me, but
Right.
and again, since I'm looking at so many stocks, like a
Right.
given strategy is about 30 stocks, and then
So
I've
it's
got maybe 4 or 5 of those strategies.
uh-huh. So how I was to maybe, and maybe I'm wrong here. If I was to think about how you're thinking, Ryan, right, is you're looking, I mean, what companies are going to grow their earnings, at a particular rate, maybe versus their valuation. Where does the balance sheet look like to help me figure out valuation? Maybe I don't know if that's part of it. And then what's the market dominance? Where are they? Are they market leaders? Is that kind of a summation of how you're looking at things in a nutshell, or am I off on that?
No, I mean, I think that's pretty accurate. I mean, really, growth is really key. Growth, I mean, it's the main factor groups. Growth, like their current growth and their forecast growth, like from analysts, uh, their valuations on different metrics, PE, price to
Right.
sales, EV, EBIT, and then some other, and then how they rank within their sectors and industries.
Okay.
That's that's important. Definitely some balance sheet factors. Cash flow is a big one.
Are you handicapping valuation for any risk? So if this balance sheet's a little risk, well, I'm assuming, um, well, maybe, well, do you omit stocks based on their riskiness? So are you only bringing clean balance sheets into the mix here, or are you actually handicapping valuation for risk but still bringing it in if the growth is there in earnings, for example?
Mhm. Not directly, but
Okay.
um, when you in this kind of approach, when you've got, we'll call it 50 factors. So you've got maybe 20 value factors and maybe 10 or 15 balance sheet factors.
Okay.
Once you rank a company on all of those factors, they tend to balance out.
Okay.
So if you've got like a nice valuation, say it's pretty cheap, it's got a nice PE or price of sales. But if there are some certain balance sheet factors that are really not ranking well, like it's highly indebted, or
Right.
it's got a really poor current ratio or working capital issues, then it'll rank low on those scores, and then they'll kind of balance each other out.
Okay.
So then what will tend to float to the top is those stocks that are cheap, but also have a strong balance sheet.
Okay.
And then kind of those guys that don't rank highly on both are lower in the rank and won't make it to the positions that actually get invested.
Okay. Yeah, because I was funny, like Hammond Power, which we talked about earlier, was a stock that I own, and I'm assuming, and I still do want to think a little bit of it. Maybe I don't know if you still own it or not, Ryan.
Yep.
But so that was a situation where you found a stock. You know, if the earnings growth was incredible. Their forecast when we found it was incredible. I think it's maybe 9 months ago now or something. But they had some debt in the balance sheet though, and it had a low PE. I think that low PE was 6 or 7, and it still has a low PE right now.
Right.
And I think that low PE was there probably because I don't know if it's the industry or the balance sheet, but it's what's interesting is it'd be awesome sometimes to see some of these. If they were to de-risk their balance sheet, maybe you get a higher multiple expansion in the PE ratio, right?
Right.
But that's where I got, where I get kind of conflicted sometimes. I'll find these great stocks in terms of their earnings growth coming up, or they've been doing really good in growth, but they have the balance sheet maybe isn't the best. And that's why the PE is where it's at, right?
Right.
And but
right.
I mean, Hammond is basically almost tripled or something. It still has the same PE it's had, right? Because it's basically kept up with the valuations, kept up with the earnings growth, basically, right? The multiples,
right?
And which, which is interesting. Sometimes in some of these stocks, you look when you look at them, they're so cheap, but sometimes they're cheap for a reason.
Yep. It's I kind of like to actually. I've got a slide on that, but actually, yeah. Let's maybe park that.
Okay. Cool.
So I don't interview management. So no scuttlebutt. Just purely quantitative. I know that's definitely a big part of your
yes
process, and that works for you. That's fantastic.
Well, I will tell you, Ryan, though, I think I do it because I think it's part of the platform, and it helps investors, that subscribe to you to see how we interview teams and how to think about a company. But I can tell you that it can be very detrimental to investing too, because what are they going to tell you?
Yeah,
and you can easily get predisposed to maybe buying a stock because they're saying something to you that's positive, right? And they're always positive.
Right.
So it's a very delicate process to figure out when you're getting fed bullshit and when it's not. I think you're absolutely right. I don't think you need to. I think you can, at least when you're looking at, I don't know, longer term, but certainly if you can catch companies growing in a cycle, earnings, in the next 6 to 9 months, that's maybe de-risked a little bit in terms of what management at that point. But there probably are ways you can, I'm assuming, factors you look at to measure management's effectiveness, I think, and right, maybe that's what you're doing, and you're 100%. Taking out the noise of the bias there, probably.
Right. No, 100%. So it might not be an explicit factor, but for example, one factor I like to use, and it was actually one of the super stock factors of Ken Fisher's, is basically share management. So I mean, what's the share issuance or dilution history of the business? So if there's a lot of dilution going on, that's kind of a red flag, and it's something that you can easily track quantitatively.
Right.
And then sometimes in the end, it just comes down to just, if the business is performing, then the management team is doing something right. And
sure.
Yeah, it's
my biggest thing for management interviews is mainly when it comes down to it, I want to understand the model a little bit, but really I want to focus on a few, and it's really, where our margins are going to go, because I can make my multi-bagger out of it, right?
Yep.
On the new products, but yeah, I guess a lot of that you can get in the numbers to some degree. You can look at the margins trends, and if you're looking at market data also, it's helping you understand the positioning of the company in the market. If maybe that's going to give you a hint of margins and be able to hold them and increase them. Maybe it's just telling you this information. So you're based, and I like that concept to some degree, of like, is this using factors to kind of maybe build this unbiased kind of opinion on the stock, right?
Yeah, no, I think it has its play. I mean, I think maybe in interviewing management, you can get glimpses maybe into the future, which the numbers won't necessarily tell you, because a lot of the number factors obviously are backward looking.
But you can use analyst estimates to some degree to help you a little bit. I mean, that's a big part of my. I know there's a lot of talk about that. That people always analyst estimates, but let's give them credit. I mean, they do their homework and
absolutely,
it works.
It
works.
does.
I mean,
it does. I use it all the time. That's what I was about to say. Is it? Yeah, you've got the backward looking info, but there are quite a few factors that are forward looking.
Yeah.
Which maybe are less biased than the management team's perspective, but
again, I think if you could, Ryan, if you could, like, if you can factor in, like, is that analyst been right? Like, if you take, like, tipranks.com ranks analysts, right? So, if you can start doing that kind of stuff, maybe that would be really interesting. Okay, this analyst is usually right. You put some weight to that, maybe, right? Yeah.
No, the different ways to approach it. 100%.
I mean, I was when I was younger, that's all I would just really look at. When I was a beginner investor and it didn't even talk to a management team yet, I would really just use these estimates, along with fundamental stuff, and that was really it. And it worked great.
There you go.
And so maybe I got to go back. Maybe I never interview a CEO again. See what happens. Yeah.
Who knows? So DCF, I mean, I've done some DCFs in the past, but did this kind of cash flow models, but maybe it's my background in engineering and hard science, where you've got kind of very specific inputs, and you've got very good data. Whereas DCF, there's a lot of assumptions. There's a lot of assumptions that carry a lot of weight in, like, even the change from a couple percentage points can change the outcome by orders of magnitude at times.
Sure.
So I've kind of early on, I kind of just said, no, this is not for me. And even in the quant strategy, it doesn't. Yeah, it's not an input. So I don't look at price targets either.
I can't tell how many times I've done a DCF, and it's been, it looked all warm and fuzzy until 3 years. Well, wait a second. Let me do it again.
Yeah.
No,
over time I have an acronym for DCF that may not be appropriate, but anyway.
Well, you know what, man? It's like if there are analyst estimates, they're doing it for you in a way. I mean, again, right?
Yeah.
And so how do you when you don't have estimates? That's where it becomes a little challenging. When you don't have analyst estimates, that becomes a factor you don't have.
Especially in micro caps and small caps, like, you won't have any, or you might have one, so it's only one data point. So it's you have to wonder, okay, how accurate is this? But definitely the whole analyst component is part of the guts framework,
right?
Which we'll get to.
Okay.
I don't hold forever, so as as we said at the beginning with that Buffett quote, and it's not that it's a conscious decision to not hold forever. It's just in these strategies, there's enough turnover that usually don't hang on to positions for really long periods. So I mean,
Right.
I've held some for maybe 2 years, but
What's your
some
average
of
holding
them,
period, Ryan? You can,
3 months to 12 months.
okay. That's exactly where I was at for that first 20 years of my career.
Okay.
Right in that spot. Yep.
Yeah. And then you can buy, sell, and then come back a
Yeah,
few quarters later. It ranks
sure.
high again. Okay, we're back in.
Say what I did,
And
where my mistake was as a young investor. It was I would have this kind of mentality that I would buy the stock, make money in it, right, and forget about it. I would never come back to it again, which was a mistake because
okay.
I would have maybe come back into a monster. But it was
Right.
like I would just like put these stocks away, and then when you do a post-mortem 30 years later, wow, MIDD, I had that, I had a monster.
Right.
I don't know, would I have bought them back? If I would have kept monitoring, the progress. I
Mm-hmm.
don't know, because I was a lot of time I'm only investing in nano caps too and micros. So once they get out of
Right.
that market cap, I wouldn't even look at them anymore. So, but yeah. So,
Interesting.
but I like that approach of going back in and looking at these things. I mean, it can be years before you come back into one of these stocks, though. You can, because they go through their cycles.
Yep. It can be years. It can be even a few quarters. Like
Yeah.
at least in my, like, the way my strategy works, sometimes just a few quarters. So I mean,
I want to come back. I want to come back. I want to come back to contrarian in a little bit too. So I want to write that down.
sure,
That's fine.
sure. Yeah, so don't really focus on individual stocks. Like, that's like, I like to write about. Sorry, let me back up. So in the strategy, it's all about the strategy, and then the strategy is made up of the 25 or 30 stocks. Twitter is a great place to maybe focus on one. So I mean, if it's still ranking high, it's still in the strategy, I might do a little write up on one, like the HPS or Coda. But generally, once the rules say no, you sell, then I sell. It's
Right.
actually, I
Right.
had one just the other day, actually, where I had a quick profile on Twitter, and then the next day it was rebalance time on Monday morning, and it was a sell. I was like, okay, see you later. Next. So yeah, I mean, and it's not always easy, especially if it's been a winner. But I will say, more times than not, the strategy has been right. So there's been something in the data that's saying either it's getting too expensive, or there's something in the last quarterly earnings report
Mm-hmm.
where like, and it's funny too, because I'll sell it, and people being people, I'll still watch it and think, oh, was I right? Was the strategy right? It goes up, and then in some cases go,
Right. Right.
and so I mean, it all depends, but that's why I guess either way, sometimes it's easier not to get too attached
Right. Of
to them,
course.
because they're kind of coming and going.
I think did I see you on TZoo also? TZOO Travel Zoo? Was that you? Or was that somebody else?
I think I did talk about Tzu at some point.
And I think you might have sold it or something.
Briefly.
Yeah. 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 So
Um,
but you say here, by the way, I want to go back to DCF and price targets. Are you setting? I mean, is your rule to sell isn't based on price targets? It's basically based on these factors, the score changing on whatever it is, right? Okay.
so it's basically rank. So if we look at value, we'll look at value in particular. So um, we'll call it three. Let's do a simple example. So say you're ranking stocks on PE, price to sales, and price to free cash flow.
Mm-hmm.
So you rank that stock, say, so the cheapest company on all three will get ranked 100, and then it kind of goes down, and then the most expensive are on the bottom. So in a pure value strategy, you would hold on to those cheapest companies, ranking highly, like cheapest on PE, PSP, FCF. But then once they start to get their valuations increase and those PE ratios increase, get more expensive, then their rank will start to drop. And then others will come up and take their place because they're cheaper.
Okay.
And then at the rebalance, you basically sell those that are no longer in the top 20 or 30 and then buy the new ones.
Okay.
So it's all relative. So it's all relative to the universe. So if I'm looking at, say, call it the Russell 2000 universe, which isn't the perfect small cap proxy, but let's just say that for now. So if I'm using that as the universe, it's the valuation relative to the entire universe.
Okay.
As opposed to say, okay, the stock is worth $20 a share, $50 a share, $2 a share.
Okay. Okay. Awesome. I mean, you are taking to some degree, probably, you're not explicitly listing a price target, but you are using kind of valuation based type of factors to figure that stuff out. So it's
100%.
it's in there somewhere.
Valuation definitely plays into it. Like it's I guess the only difference, Maj, is that it's relative. So it's not
Right.
an absolute valuation target. It's more relative.
Okay. Got it.
And then sometimes, well, not sometimes, but what you can do is instead of ranking within the universe, you can rank within the industry. So I mean,
Right.
if certain industries have got different PE ranges, like some industries have higher valuations, you can rank just on the industry level. Yeah, so that's a different approach too.
Okay.
Okay, so yeah, so no options, no shorting, and no ETFs or mutual funds.